How do you feel that has helped you in your job as a loan officer?
It's easy to make decisions for other people when your money's not involved. When it's a job to us, it becomes like, oh, yep, this is what you need to do, and the emotion comes out of it.
Hey everybody, welcome to another episode of the Property Pros podcast. I'm Mark Goldwich.
I'm Peter LaFramboise.
We're both public insurance adjusters in Jacksonville, Florida, but interested in all things property. And today we've got a great guest for you. Quinn Barnett is a mortgage loan officer with Direct Mortgage Loans. And Quinn, I know you and I have known each other for a little while. We're in a B&I together. But actually, we were talking a few minutes ago, and I just learned that besides being a loan officer, you also are a real estate investor yourself. Tell us a little bit about yourself, your company, what you do, and then get into a little bit about your trip into real estate investing.
Yeah, that's one good question, should cover half an hour worth, so I will expound on that. But I went to school for engineering, and then as soon as I got out of school, someone introduced me to the Bigger Pockets podcast, which was really when my gears started turning on real estate. And listen to that thing like gold over, listen to that thing like the Bible over the next year, and then ended up buying our first home, which I will get into. But whatever you're going to invest in, it's good to understand or invest with someone that you trust who understands it. And so real estate can be a good investment, and certainly you need to understand it, which I was able to do some there, and that dipped my toes into the water with buying a multifamily house for us to live in and then rent out the rest of it. And I started as an engineer, worked for that for 2.5 years, kind of established myself before jumping more into the world of real estate for a few reasons, including wanting to be with the end customer more rather than working with my computer and Excel sheet all day. I wanted to feel like I was making more of an impact, and certainly helping people afford a home. One of the biggest purchases or investments of their life is making an impact with the end customer. And also having the freedom to work at all hours of the day rather than just 9 to 5. So working for myself tends to do that. And I've recently moved to Jacksonville, Florida, the great, bold new city of the South that you guys have been working in, and loving it down here. The real estate is good on all aspects of it, as we continue to see an influx of other Northerners like myself joining Florida.
So, Quinn, when you moved to Florida, were you already a mortgage officer at that point in Virginia before you came down here?
Yes, so I've been working with a local company there in Lynchburg, Virginia. They were good, helped me start out, were about relationships and availability, and were very good at making sure the loan closed, which is something that everybody worries about. You hear horror stories about not knowing whether your loan was going to close and then something happening or getting pushed back for 2 weeks. That is what we fight against, to have a smooth and informed closing process the entire way and closing on time, so that it brings peace of mind through the big transaction to everyone, including the realtors and the seller, not just the buyer. Once I got down here, though, I was no longer a local lending company, so I talked with some companies that had a few more tools that I could put in my tool belt to help out the buyers, and then my realtor partners as well, and had better rates and better systems so that I can touch more people and help more people get into their home. Which,
Cool.
That's why I switched to Direct Mortgage Loans, and I've been with them since February, and it's going well. We've closed a lot and are working for the best year yet.
All right. What do you see as the main differences or the differences that stand out between where you were in Virginia and here in Jacksonville, Florida, between the market, the people, time to close, prices, whatever?
Yeah. Market size is the first one, and while that area is growing a lot, both Lynchburg and some Roanoke, with the schools that they have there and what's coming to the area, it's just not like Jacksonville. On my 25-minute commute to work, I drive past at least 4 new developments that are going up, and the area just can't build fast enough, which is great for the market, and there's just so many people wanting to buy a home that it's more competitive with the prices here. There are areas that are still really affordable, and it just, is it the area that you want to live in? Is it close enough to where you need to be? Those factors in the hot spots, whether it be towards beaches or San Marco or other parts around Jacksonville that are they've seen a lot of appreciation recently, and doesn't look like that will change anytime soon.
It's funny that you're talking about moving here and all the things we have. When I look over his shoulder and he's got a picture of the pier and the beach behind you. So was it lifestyle that brought you to Florida or work stuff?
I love being in Florida. I wish that I had more time for the lifestyle of it, and I know that I will going forwards, both dipping my toes into the water now and then finding ways to be around it. I first came to Florida at the beginning of college for spring break, and then I think I've been back twice at least every year since, and it's crazy to think that I'm here now. So I love the outside, love beach volleyball, love the ocean, all good things.
Quinn, I remember back when I was in real estate myself, a realtor, and most of the realtors in the office did not invest in real estate. Yet, as part of their job, they were constantly telling people that they should invest in real estate. And I always thought it was odd that these real estate professionals didn't themselves invest in the product that they were telling everyone else to invest on. So I especially appreciate that that you've done some real estate investing yourself. How do you feel that has helped you in your job as a loan officer?
Yeah, so it's easy to make decisions for other people when your money's not involved. Which, when we're doing the same, when it's a job to us, it becomes like, oh, yep, this is what you need to do, and the emotion comes out of it. Whether it be buying a home recently or buying a home, the first home once right after I had gotten married, and investing as well, it reminds me of the emotion and the what do I need to do? How is this going to turn out if it doesn't work properly? Which lets me be emotionally involved and remember what my customer is going through. And as you said, like, it gives truth to my my claim and my talk that, hey, this is a worthwhile investment that we are going to see both appreciate and hopefully cash flow for you as well, that, or be affordable if it's your personal home. And my belief in it, like, I'm not just saying it to make the sale. Like, the proof is in my choices as well as the last 100 years minus 5.
Minus the 5 bad ones.
Yeah.
Oh, that's interesting. Well, Quinn, we want to thank you for being on the show. And for those of you that are listening, we want you to like, comment, and share. And if you have questions specifically for Quinn about the current market, interest rates, where do we go from here, just drop a comment and we'll try to get him in touch with you so he can get back to you as quick as possible.
Yeah, we love it when you comment because, that's what keeps the conversation going. We know there are others out there that have similar questions or comments. So, take the moment to subscribe if you haven't done it already, and comment on this episode. Subscribing helps you be notified when there's future content coming. So be sure for you folks out there to take a look at that. Quinn, you're talking a little bit about investors. I imagine you have some investors that you deal with that are repeat investors, or they have multiple properties. Any experience with either what goes on during the closing process or maybe just after they purchase where they have a loss at the property, fire damage, storm damage, anything like that?
Yeah, that's not as much my field, but there's two things I would say to that. One, we have to make sure that they have good insurance. No one's able to close on a home unless that they are insured for the replacement of it. And that means that it may not be the same cost they purchased it at, but if it costs 250,000 to rebuild, they need insurance for that much because they may only be owning 20 grand of it to begin with. And the rest of that is owned by my company or whoever is mortgage servicing. We want to protect our money as well, of course. And so we need to see that that is covered. After that, we would connect them with someone like you guys to make sure that the homeowner gets as much as they should, so that nothing is coming out of their own pocket. Both of those things protect the homeowner, having good insurance and then talking with experts to make sure they get paid for everything they need to.
And I guess that's been it's a tricky subject here because that's been one of the harder things to accomplish when you're underwriting for a loan, right? For somebody buying a house, insurance has been tricky.
In Florida, insurance prices have been going up, but one, I'm working with some good people that I would say are experts, both with knowledgeable of knowing what type of insurance and how much the homeowner needs to get, getting it for us quickly, and making sure it's at a low price as well so that we can keep our DTI or debt to income ratio in line and make sure they still qualify for the home. There are insurance companies that are leaving Florida, but the only issue I think that we've had this year was on an old manufactured home, which is always going to be your hardest to insure because the value just doesn't stay there the same as with any site-built property.
Well, yeah, that's true. It's common that I've heard from realtors and whatnot that I thought once the legislation got passed that things had started to get easier, but apparently it's just as hard as it was in the last couple of years. Anyways, on a different note, so we talked a little bit before this episode started. We talked about getting rehab loans to purchase something or refi, and I'd like you to elaborate a little bit about that for the people that are listening or watching.
Yeah,
What might be some of the reasons that we want a rehab loan to either purchase a home or refinance?
yeah, it's a good way of being able to improve or to add on or to build something or to the basics of it would be fixing up your bathroom or your kitchen because those are two of the prime spots in the house that need redone. And with the purchase, you would, let's say, buy a house at 200,000, but it's not fixed up yet, especially because there's limited inventory in the market right now. Maybe you can't find the home that you want in the quality or condition that you would want to move into. So buy it at 200,000, and then if it needs 50 grand of work, that 50 grand is all rolled into the same mortgage. So you're going to be making one payment on it, and the companies, construction companies that come in there, contractors, and do the work in the first month or 3 to 6 months after you buy it, and then they get it all fixed up, and then you've got a normal fixed rate mortgage going forwards, which lets you find more homes than just the ones that are fixed up and top dollar on the market right now. During COVID, when everything was going so fast and 72 hours on the market, it was sold for sure. There wasn't time to set up every inspection and get the quotes from the contractor and make sure that everything was in place for a rehab loan. But now that things are sitting a little bit longer and it's a different kind of competitive now. So the rehab loans allow for some buyers to get that first home or the next home that they want in the condition they want. A friend of ours, Mark, is actually looking at a refinance where they're taking their current home in their mortgage, they're going to add on to it because that's besides just fixing up what you have, you can do the roof, or he's making an addition with another master on the home, and that's going to be just some tens of grand more, and to the current mortgage, they're going to get that done over 6 months. And instead of having to buy again, he's going to make the house of his dreams.
Very cool. Yeah, and I'm certain that the rehab loans is part of what we talked about. People buying in the current market or how they buy in the current market. But wanted you to talk a little bit more about buy down options and negotiating for better purchase prices. If you have some tips or strategies.
Yeah, it certainly is competitive and market right now. Some people will say that it's harder than before, but the truth is, like, whatever the current thing that we're going through is, we haven't figured that out yet. 2 years ago, even 18 months ago, after COVID, we were in a very competitive and tough market that there were some people complaining about, and it was tough to buy in for the first time. But once we figured it out, we move on to the next thing, and that's what we're doing right now. Figuring this out, how first-time buyers or repeat buyers can get into their home affordably. Two great ways to do that are buy down. Normal interest rate buy down or discount points is paying a certain amount of interest at the beginning of the loan at closing so that you have a lower interest rate. An example of that would be paying 1 interest point or percent of the mortgage, 1% of the mortgage, to move your fixed rate from 7.5 to 7%, which saves you money over time every month, obviously. There's a break-even point on that. Usually, if it's like 24 months or in that area, maybe 3 years at the most, I would suggest it to my buyers like, hey, you can save money potentially this way. But there is also temporary buy-downs, which let you get your money back. In the 2-1 buy-down is the best example of that, which the first year, you're 2% lower than your fixed rate. The second year, you're 1% lower. What that would look like is a 5.5% rate for the first year, which is saving you a lot monthly. And then in the second year, 6.5 before 7.5 for the 30 years or however long your loan is with that fixed rate. It really lets you ease into that payment and then gives you time in case the market goes down, the interest rates drop. I mean, the interest rate market goes down. It would let you refinance and get that money back because it's only there in an account waiting temporarily. With permanent buy down, it's a sunk cost. So if your break-even point is 40 months from now, more than 3 years from now, but the interest rates go down by the end of 2024, then you can't get that money back. You can refinance lower, but the money that you paid up front, you're not going to get back. So depending on the situation, is which one I would suggest for my buyers to do. I have had buyers that I pre-qualified. I just had one that I pre-qualified for around 350,000, but they were shopping over 370, 360, 380 even, and saying, "Hey, can we buy this one?" And what worked for them was to buy the interest rate down a lot, so the break-even point's far out in the future, but we needed that monthly payment to be low enough to qualify at their debt-to-income. So the sellers are able to contribute to that buy down. So they paid half of the interest rate buy down, which the agent was great in negotiating that much of the sellers to come out of pocket for. And then the buyers paid half. So they got a permanent fixed rate down in the mid fives and bought for 18 grand over what I told them they could buy with a monthly payment that they were still comfortable with. So those are all ways of negotiating, of getting a lower payment, either right now or always, that lets people buy the home they want.
Wow.
Great example of why they need a professional like you to give them these options. They have to know that the options exist, and for you to be able to figure this out for them and to know it as thoroughly as you obviously do.
It's honestly a balance every time, and every situation's different, because you have how much do we want to come out of pocket to close with the loan, what is our credit score and income, and then how much monthly payment are they comfortable with. So you've got a little triangle that we're trying to balance on top of a peg, and where's the perfect balance for the buyer and for the home that they want to get into.
It's good to know, Quinn. Thank you very much for being a part of this and teaching our listeners a little bit about you and more about how complex the mortgage business has gotten with the interest rates having risen like they have. How can our listeners get a hold of you?
Yeah, so thanks for having me on. It's been a great time getting to know you, Peter, and seeing Mark again. My company website is directmortgageloans.com/Quinn-Barnett is my site. And then also on Instagram, some of my life, my new life in Florida with my wife and my 5-month-old baby girl often make it onto my Instagram, which is KWINB3. Kwin, so Quinn spelled differently, and I love interacting with people on there and keeping up with them as well.
Well, thanks again, Quinn. We really appreciate it. And thanks, everybody, for tuning in to this episode of the Property Pros Podcast. Be sure, like we said, like, subscribe, comment. That way you stay involved. You get to see content that's coming down. Check out prior videos at Property Pros Podcast on either YouTube or Facebook. Until next time, have a great day.